In recent years, AI has become the hottest topic in the capital markets. From Nvidia's market cap skyrocketing to global tech giants pouring billions into computing power, two main narratives have emerged. One side says AI will reshape industries and spark a new tech revolution. The other warns, current valuations and investments may already look like a bubble. Recently, Nvidia's CEO Jensen Huang gave an interview where he said China is only a few nanoseconds behind in chip development. At the same time, he urged the US not to rely only on restrictions, but to compete head-on. That comment immediately triggered backlash from US Republicans, some accusing him of being too pro-China. But this video isn't about politics. For me, this interview highlights one key question. Is there really a bubble in AI? And towards the end of this video, I'll also share, if AI stocks really do burst, which sectors could carry less risk and maybe even continue to benefit? On one hand, Wall Street analysts think Nvidia's explosive growth will normalize after 2027, going back to single-digit growth. On the other hand, Jensen Huang says AI is like a new electricity revolution, and you can't measure the future with yesterday's ruler. So here's the big question. Are AI stocks overhyped? Or is this just a revolution the market hasn't fully priced in yet? Let's break it down step by step. Huang revealed that Nvidia and OpenAI are working on a 10-gigawatt AI infrastructure project with investment up to $100 billion. Sounds huge, right? But that's only the starting cost. Once you include grid upgrades, cooling, long-term power contracts, and maintenance, the real cost per gigawatt could be $7 to $10 billion. And the biggest pressure? Power bills. A 10-gigawatt facility could burn through $3.5 to $9 billion in electricity every single year. Now, if OpenAI builds this compute factory, do you think Google, Meta, Amazon, Microsoft, or even Middle Eastern sovereign wealth funds will just back and watch? Of course not. This triggers a global arms race. That brings three major risks. Capital pressure, more fundraising, more debt, but old facilities haven't even generated positive cash flow yet. Financial risk, overlapping investments turn AI infrastructure into a black hole for banks and bond markets. Overcapacity, too much supply, pushing down compute rental prices, while sunk costs remain huge. So yes, demand is real, but if everyone rushes in at once, it could look a lot like the old railway bubble or fiber optic bubble. The infrastructure arrives too soon, the investment cycles drag on, and the returns just can't catch up. Huang says, for tech giants like Google and Meta, buying GPUs isn't a choice. It's survival. Even a 1% gap in compute power could mean losing the whole market. He even calls it a survival tax. And he gave what he calls a productivity equation. Take a knowledge worker earning $100,000 a year. Give them a $10,000 AI tool that doubles productivity. The return on investment is obvious. That's why these expenses aren't optional anymore. They're baked into every company's financial model. But here's the problem. Costs won't fall over time. They'll keep rising. Unlike PCs or smartphones, where mass production makes things cheaper, GPUs don't work that way. Each generation means a new architecture, a new process. And with AI demand exploding, shrinking nodes isn't enough. So designers make bigger dies, or use chiplets, cramming in hundreds of billions of transistors. Data tells the story. V100 back in 2017, about 815 square millimeters. Then A100 and H100, still around 800 square millimeters. By 2024, the B200, it's a dual die chip, packing over 200 billion transistors. In other words, chips keep getting bigger, yields lower, and cost higher. That leads to cash flow stress, constant investment, uncertain returns, financing pressure, more bank debt, higher capital costs, industry shakeout. Weaker players may get acquired, or simply go bankrupt. So yes, demand is real, but costs keep climbing. It's a long race of who survives the burn rate. Some worry Nvidia's investment in OpenAI looks like circular financing. Nvidia invests money. OpenAI uses that money to buy Nvidia chips. But Huang's strategy is bigger. Nvidia isn't just a supplier. They want to embed their DNA into the next generation of AI companies. Once you're locked into their ecosystem, switching out is extremely costly. It's basically the same playbook Microsoft used with Windows in the 90s. Every software company had to build on Windows, and leaving was nearly impossible. Now, Nvidia wants to become the Windows of AI. So in the short run, it might look like Nvidia is just selling to itself. But in the long run, it's really about building a moat, locking customers into their ecosystem. Analysts estimate that every 1 gigawatt of AI infrastructure could bring in about $50 billion in revenue. But here's the catch. That $50 billion goes to Nvidia, because OpenAI has to buy their GPUs. Whether OpenAI can actually make back that $50 billion or even more, that's their risk, not Nvidia's. Put simply, Nvidia is making money by selling the shovels. OpenAI and the others are the gold miners, and whether they strike gold or go broke, only time will tell. AI expansion isn't just about tech, it's also about energy and money. By 2025, training AI could use up to 200 terawatt hours of electricity, about the same as a mid-sized country in 1 year. In the US, data centers already take 4 to 5% of the grid, and this could soon reach 10%. The catch? Each new GPU is bigger and more power hungry. Instead of getting cheaper, AI compute is only getting more expensive. And then there's finance. These mega data centers depend on heavy debt and long-term power deals. If rates rise, energy prices spike, or credit tightens, projects can stall or even collapse. So if the AI build-out keeps accelerating, it won't just reshape tech. It will drag energy markets and financial systems into the battlefield. Against this backdrop, geopolitics is of course unavoidable. In an interview, Jensen Huang remarked that China is only a few nanoseconds behind. What he meant was that the gap between China and the US may not be as large as many assume. That makes it inevitable for China to pursue its own AI and semiconductor ecosystem as a policy priority. According to the AI Index Report 2025, China has established a semiconductor fund of about $47.5 billion to support domestic chip and AI companies. At the industry level, research firms project China's semiconductor market will surpass $200 billion by 2025, with mid to high single-digit annual growth. That said, the report also acknowledged that Chinese AI chips still lag behind leading US designs, such as Nvidia's. For example, Huawei's AI chip yields reportedly improved from around 20% to nearly 40%. That is progress, but still several generations behind global leaders. Meanwhile, China is enforcing domestic substitution policies, requiring new data centers to source a certain share of chips from local suppliers. All this shows that China is indeed spending heavily to catch up. So why did Huang say what he said? There are several layers to it. Protect the market. China is one of the largest global investors in data centers and AI, even with export controls. Nvidia doesn't want to lose this market entirely. Lobby US policy. Huang is signaling Washington. Don't just block, compete. Full bans choke Nvidia's shipments, but competition allows Nvidia to benefit from policy support. Promote sovereign AI investment. By saying China is catching up, he's really warning other countries. Invest now, or you'll fall behind. Ultimately, Nvidia still wins. Maintain neutrality. As a global giant, Nvidia cannot afford to alienate either side. This wording avoids antagonizing China while keeping dialogue open with the US. In other words, the few nanoseconds behind line was more of a strategic business, political, and market positioning statement, not evidence that China has already caught up. To sum up, China is indeed pouring real money into chasing AI progress. There are signs of improvement, but the gap remains. Huang's remark was less about China's actual position and more about balancing China's market, US policy, and global investor sentiment. Here's my conclusion. AI stocks do carry a bubble. Valuations have run far ahead, especially before these massive deployments are fully in place. But AI technology itself is not a bubble. Because demand is structural, driven by corporate competition, capital spending, energy use, and financial systems. The so-called bubble is really about the mismatch between valuation speed and adoption speed. Once the technology fully lands, value will naturally recalibrate. Even Elon Musk has to buy Nvidia chips to train Tesla's self-driving. That proves the difference. Musk is the flashy front stage player, but Huang is the house. Everyone, including Musk, must buy his chips to play. In fact, Huang's influence may one day surpass Musk's. Because in this great AI casino, he isn't just a player. He owns the table. His message is blunt. Follow me. Maybe you die. Don't follow. You definitely die. If you want to play, you need my chips. Now, whether you make money or not, that's not his problem. And the AI black hole keeps getting deeper. The more money everyone throws in, the more ends up in Nvidia's pocket. At the same time, Huang is also signaling to Washington, don't block me from doing business with China. How the US chooses to treat a CEO trying to straddle both sides is still an open question. Will it tighten pressure or allow room? So AI is undeniably fueling an industrial revolution. The demand is real, but the market valuations and adoption timelines don't match perfectly, which means short-term volatility and bubbles are inevitable. Where should investors look if AI stocks burst, but you still want exposure? Energy sector. Data centers will keep consuming power regardless. This includes utilities, renewables, storage, and solar inverters. And one overlooked beneficiary is silver. Solar panels require large amounts of silver. As data center growth drives solar expansion, silver demand rises. According to the World Silver Survey 2025, industrial demand hit a record 680.5 million ounces in 2024, driven by photovoltaics, grids, EVs, and AI electronics. India's renewable build-out in 2025 is also adding to the surge. Semiconductor supply chain, memory, networking gear, and cooling infrastructure. These picks and shovels are more resilient than pure AI applications. Cloud and data center REITs, rental-based models that benefit from long-term compute demand, regardless of which AI apps win. In other words, even if AI stocks crash, these sectors could serve as safer harbors. The real question isn't whether AI is a bubble. It's how you choose to participate and how you control your risk. This wave is still unfolding, but we can all decide carefully where we want to stand. Thanks for watching. If you enjoyed this video, please like, share, and drop a comment with your thoughts on whether AI is a bubble or a revolution.